Hello, everyone. This is Chris. It's December the 5th, and before I forget about it, it's hard to believe how fast the year has went. I want to say we appreciate your membership, and I want to wish you happy holidays, Merry Christmas to everyone, and we're going to go ahead and get into the webinar, and we'll look forward to it. It's been a good year, and it's been a great year actually, and then we'll look forward to even some more exciting things towards the rest of this year. But I want to remind everyone that we're not a bear shop, we're not bullish or bearish, other than bullish on opportunities. The main thing is, if you look at a chart in the lower left-hand corner of the chart, if something's heading from the lower left-hand corner to the upper right, we're interested in owning it. Whether that's a bond, a stock, an ETF, a commodity, or an inverse ETF, if it's heading from the lower left to the upper right, we're interested in owning it. And just a reminder, you know, that charts, they tell you what is happening price-wise, but they don't tell you why. I'm not into the why part or excuses of things. I have, very humbly, everybody, it's above my pay grade. As the market went up because of the tax bill or whatever, I don't know. I just really humbly don't know. I don't care. And you don't see me mentioning it. I'm just trying to find the right assets that are going up in price for us. So as a reminder, the power of the pattern, we hope to be your 28-second solution to invest research. We want to be able to let you look at a chart, see why we like it, the action we want to take. Most of all, we want to show you where if we're wrong, which does happen, always will happen. There's no way to get around that. But we want to share with you how we're going to apply risk management to every position that we have. So let's start with stock indices. And as I have many times, I think the two charts say so much of what's going on in the markets. These are the advanced decline lines, any common stock only. Any other vehicles in the advanced decline line have been stripped out, especially with the one in the upper left in the NYSE. There can be closed-end funds and closed-end bond funds, so this is stocks only. The trend is beautifully, strongly up. You know, a lot of people have talked for almost a year now about valuations being lofty, and which they are, but that hasn't stopped prices from going up. I lived and invested through the 90s, and you know, valuations were lofty for a long time, but it didn't stop the markets from going up. What counted when valuations were lofty in the 90s was price, and when price went against people, that's what mattered. And guess what? That's what's the same today. Is price is what matters, and if price starts going against things, then we'll try to adjust our portfolios accordingly. The one thing that does stick out, a couple of things, very quality uptrends. They're both close to all-time highs. There's nothing bearish about either one of those. They both are testing the very top of the rising channels that they are in. The last time that both of these hit the rising channels was in 2015. And you can see that they consolidated and actually went from the top of the channel to the bottom, to where then they took off in 2016 to the higher upside. So again, there's nothing bearish about this. This could just be a price point where these markets could, what I want to call CIB, they could catch its breath. This would be logical for that to happen up here. But right now, a bullish message is coming from both of these. There's no doubt about it. One of the charts that we have continued to share in the Dow Jones Industrial Average is the chart on the Dow. Apply the Dow to two of the most considered most important emotional price points in the last 10 years. And this is a monthly chart, and the emotional points that I'm talking about is the closing monthly high in 2007 and the emotional monthly closing low in 2009. So we applied the Fibonacci to that. I don't know about any of you, it's still pretty amazing to me. In 2009, that would have been my, I got into business in 80, so that would have been my 29th year. And as I was watching investment banks implode, you just wondered where everything, was going. As it was imploding, the Dow was below 7,000. If you applied this Fibonacci at the time, it would say two key levels in the future to watch are 18,000 on the Dow and 25,000 on the Dow. The 18,000, where did that come into play? Well, that's the 161, or 161% of the distance between the 2007 high and the 09 low. And you'll notice that in 2015, on the prior screen on the advanced decline line, I mentioned that the advanced decline line was hitting the top of the rising channel in 2015, and then it went sideways to lower for an entire about 18 months, almost 2 years, to 2016 before it headed higher. So you'll notice, what did the market do when it went and hit the 161 level? It chopped from late 2014 until it broke out early this year. So as we look back on hindsight, that was a large base being built at an upper level Fibonacci price zone. So we had highlighted this at 2015 and talked about this was an 800-pound gorilla. Until it broke from that, it was a heavy resistance. And then if it could take that out, it was a real positive. And obviously it did take it out. And so now we've it leaped over the 161 level again. That was at 18,000. These numbers are published every week in the global dashboard. I've stuck with this chart because I try to put it at the first every one because I just think it's that darn important. And so now the target that we've been sharing for the last couple of years for the Dow from a Fibonacci extension level based upon the 2007 high and 09 lows is 25,000 in the Dow. We've been sharing that week in and week out for the last year and a half. And as you all know, the Dow is above 24,000. So from a hand grenade perspective, we're really close. With the Dow being at 24,200, almost 24,250, and the target being around 25,000, the Dow was within 5% of the target that was set back in 2009. And so the Dow is really, really close to this level that, who knows, maybe some of this same type of price action takes place that we saw at the 161 level. I would be surprised if at the 25,000 level, if it makes it, that it doesn't try to sib again, catch its breath for a while. And then no different than the 161 level, it caught its breath for well over a year. And I wouldn't be surprised if it doesn't try to catch its breath here. But again, if it would take out the 25,000 level, what do you do after you catch its breath? Whew, I've now got some new energy to head forward. So I do believe that this will, doesn't mean it will be a stopping point. I'm not saying that, but it is a price zone where I wouldn't be surprised that if the market doesn't try to catch its breath for a while. And when you think of a market that's went from the low of 7,000 up to 25,000, and especially went from 18,000 to 25,000 pretty quick, it deserves to catch its breath. That's pretty vertical. As you can see, it's the most vertical part of this entire chart off the 2009 lows. Just a reminder from a historical perspective, this is from Ryan Dietrich, good buddy. This is just a chart of looking at each month's performance. And so the average return of December is over 150 basis points, over 1.5%. And you can see from a percentage of time higher, and this is from 1950 to 2016, it's almost 75% of the time the month of December is up. We hear the Santa Claus rally and all of this, regardless of going back to the whys. I don't know why, but regardless, December is usually a strong month with 3/4 of the time. Another chart from Ryan talks about that December has never been the worst month of the year. So this looks, since 1950, how many times December was the best month of the year, and the worst, or each month, excuse me, was the best month of the year and the worst. As an example, you can see the best month of the year typically is April, with the worst month of the year happening 12 times over 60-some years. So August, obviously, that's the summer weakness. But if you see in the lower right, August has not many times been the best month of the year. And so far, it's never been the worst month of the year. And I think I saw Ryan mention or someone on TV that it would take like a 1% decline or something in the month of December to break this record. So I don't know that it's going to happen, but just kind of a reminder that typically 75% of the time December is up, and it's usually not down very often or not down much. So as a reminder, this 4-pack to me is very important. We have the S&P in the upper left, banks in the upper right, the BAX index, small in the lower left, and transports in the lower right. And you'll notice the two indices from large cap, small cap, all of these have this look of a bullish ascending triangle. As you know, we played a lot of ascending triangles this year to a high degree of success. Some of them made us some really nice gains. You know, this pattern results in upside movement over 2/3 of the time, and also provides you an opportunity to look at a measured move of how high it could, any indice or asset or ETF could run to the upside once the breakout takes place. So to me, the two healthiest charts are the ones on the left that they broke out and they didn't really look back much. On the other side, it's not that they're not healthy, but you'll see maybe they even are healthier in a different way. Banks, you can see broke out and then came back to test the top of the ascending triangle, which often happens. There's one of two things that, there's three things obviously can happen. One is a breakdown, but that's 1/3 of the time. But 2/3 of the time, you either get a direct breakout, or you get a breakout and then come back to test old resistance as new support and then push higher. So you'll notice that this past week, banks and transports, they just blasted off. They broke above the top of the triangle. They came back to both test support at 2, and then they pushed nicely higher. Now the week's not over with. You know, we saw transports really strong last week, and I think it was even yesterday. Then we saw some weakness today, but some very impressive upside action off of support with the trends that are taking place to the upside. One of the things I wanted to share with you is this is a long-term look at the bank, which would be a XLF, and divided it by SPY, so it's financial to the broad market ratio. And for you premium members, last August, I didn't draw the resistance line in, but right here was when in August of 16, excuse me, last year, so about 1.5 years ago, we started seeing some strength, and we saw a breakout here. We bought XLF, and we rode it higher, and then I sold the majority of the position into strength as 2 overhead resistance lines look to be tested at 2, while momentum, in other words, that banks, excuse me, were outperforming the S&P to a degree that the relative strength or momentum was the highest since the 2000s. So this was the highest momentum in 17 years. So that's why I peeled back in the in-between time with kept a small percentage of XLF, have bought some Goldman Sachs and sold it in the in-between. But I just wanted to update this chart. You can see that momentum has, this has been now a year. You can think that happened right at the beginning of this year. So it's went sideways for a year. Momentum is not oversold, but it's back to the middle of the range. Nothing really impressive in either way, bullish or bearish here, but it is back in the middle of the range. But you'll notice that the ratio now is attempting to break above this long-term line that's been in play for almost 14 years at 3. So we're seeing a breakout being attempted by the banks. Went and repurchased XLF. Still have some of the original shares from last August. I believe they're up over 40% so far. And then if we went and repurchased XLF just in the last couple of days as a breakout is being attempted, which in other words, banks are reflecting relative strength against the S&P. So potential positive taking place. So this is a look staying with the same theme of banks. This is only the bank index, which is the BKX, going back over 20 years. you'll notice that from, what would you say, everybody, from the mid-90s until 2007 and 8, that the bank index chopped inside of this rising channel 1. So it hit the top of the channel in 2007. Look at this, everyone. It came down and bang, 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 tested a support, and then it slipped. And so we saw a large decline here. A counter trend, moved back up, tried to get back into the channel, and then was just a waterfall. And so this, I've been sharing this many, many times over the last several months as it is an important indice. This was one of the charts that helped me to liquidate and take profits. This is where XLF was bought in August of 2016 here. We got this strong ride up, sold and harvested, created a good bit of pocket change right into hitting the underside as it kissed the underside of this resistance, and that's why I just pulled the majority of the shares off the table. You'll notice for about a year, it's just went nowhere, chopping back and forth. Then we can see an attempted break above, getting back into the channel, some weakness that then tested for the first time since 2008. It tested the underneath side instead of as resistance, as support a couple of weeks ago, and then bang, we saw this really strong move higher at 3. So for right now, really like what we're seeing in this bank index, and so still have part of the original shares of XLF and then repurchased, so we'd be overweight in banks at this time. We'll continue to due to some things we'll talk about later in the webinar, keeping stops fairly tight. But to me, this is some pretty impressive price action, and I'm just like we're saying, don't think bananas. I'm not going to try to say what this does or doesn't mean to other pieces. What matters to me is just the price action that we see here, and at this time, it's positive. Moving on to other that are important for stocks is this is a look at junk bonds that we share every week in the global dashboard. You'll notice that essentially for 2017, junks kind of went nowhere. It's just junks in the trunk, just kind of chopping back and forth. But when we saw some weakness here 6-8 weeks ago, we saw a little softness in the stock market. And then this is a weekly chart, so 1, 2, 3. A month ago, we saw bullish reversal wicks take place at the prior lows in the spring of this year. And as junk has moved a little higher, not a lot to brag about, but that's where we saw some of the better stock market movement of late. But there's not a solid message coming from junk other than there's resistance overhead. We see the support, fairly tight range. The message for stocks would be a breakout to the upside, would send a bullish message from junk to stocks. And if we saw a breakdown, it would be a concerning message to stocks. So a lot of choppiness going on. This still remains a great indicator. Fell in love with junk in the 1990s as a message. Junk started turning weak in 1998, almost 2 years before what most people think is the high in 2000 in the S&P. But if you get time, go back and look at the New York Stock Exchange. It peaked in 98, and so did junk, and so did the advanced decline line. So there was a heck of a divergence going on then. Don't see any kind of a divergence like that taking place now in the advanced decline line or in junk. But junk is not sending this really pat the bull on the back positive message, nor a negative one. You can see momentum has continued to set a series of lower highs, and now it's back at near the lows of last year of 2016 at 2. A look across the pond over to London. As I say in the box here, there's no doubt the trend remains up. It remains inside of a long-term rising channel. You see the bottom down here are the 3 and 09 lows. And I zoomed in to give you a better look, but the top of the channel is tied to several highs over the prior 20 years. What I did do is apply a parallel line of the lows to the one of the counter trend highs in the crash, in the financial crash. that happened all around the world. And you can see right here, this was an emotional point. And you'll notice earlier this year that London hit the top of this, or was kissing the underside or the top of the channel. You'll notice the blue shade has just been pretty much sideways. Tried to break out again about 6 weeks ago, and has turned back. Small declines taking place, nothing huge. But I would say that if the bottom of the blue shaded area and the rising support at 2, if that would break out, it would be a concerning message to bulls in Europe, and I imagine that it would get the attention of bulls in the States. So a really important price point, in my opinion, for London is taking place. Something's taking place in France. This is the CAC 40. This is not as long-term of a channel, but over the last 3 years, you can see it's traded inside the rising channel. It kissed the underside of this 1, 2, 3, 4, 5, 6, 7, 8 about 2 months ago. We had a doji star reversal wick at 1 here, and then we've seen a little bit of a softness, not a lot, on a percentage basis, but similar to London, that if France would break rising support at 2 and the lows that have taken place of some of the weakness that's taken place of late, that would send a short-term caution message to bulls in France. And again, I believe that it's, we live in a highly correlated world. One of the things that I don't say real often, but I have every once in a while, is before my friend and mentor Sir John passed away, his comment was, we live in one of the riskiest investment times of his life. And remember, he was around through the 30s, and arguably one of the best investors of all time. And when he said, that this is one of the riskiest times ever, a lot of people would say, well, he's speaking of valuations, or he's something along that line, because a lot of people believe that he's famous for that, and he was very great at it. But what he was speaking about was correlation. That he said that, when for the majority of his 50, 60-year career, there was a lot of zig and zag around the world. He found a lot of success that, think about this, everyone. From the mid-60s to the mid-80s, the Dow essentially was at 1,000 in the mid-60s. I got in the business in 1980, and in 1982, I got my securities license, and nobody wanted to buy any stocks from old Chris, because guess what? They hadn't gone anywhere for a decade and a half. But during that time frame, Sir John averaged 15% a year, while the Dow was flat for 15 years. How did he do it? He diversified and he went overseas. And so there was, at that time, there was a lot of non-correlation. And so now there's a lot of correlation that is, as we all know, is that sometimes one country can sneeze and the world can catch a cold. So the correlations are high. That makes it challenging. I don't care if you're an RIA, a financial planner, somebody's running a hedge fund, somebody's just doing their individual thing, or me. We all have one thing in common. It's correlations are high. And even though we can own a lot of different issues, that oftentimes that diversification doesn't get us to lower the risk, because that correlation is high. And that's why I want to keep showing these indices around the world, because like what a lot of those do are highly influential to what happens in the States. And this is not about the chicken or the egg, who's the most important market. This is about just common price patterns all over the world. All right, so next chart, just kind of as a reminder of, this is one of the few negative divergences that we've seen taking place in the marketplace. And this is where we're taking equal weight and dividing it by cap weight. So the left chart that we include in the dashboard every week is the equal weighted S&P ETF, which is RSP, and divided by SPY. And you can see that since the beginning of the year, that it has been heading south. Now that has not stopped the market from going up. And on the right side is the equal weighted tech ETF, QQQE, divided by NDX, the Nasdaq 100. And you can see that it also has been creating a series of lower highs this entire year. Now, neither one have stopped the market from going up. This is not bearish in of itself, but what this does suggest is that fewer stocks are powering the market higher, which, as you know, that we're very open to trying to find opportunities in individual stocks. And this just means that you got to even be more careful because fewer stocks are powering things. Even though this has been a very good year for the markets, it's been a great year for us, there's been some air pockets out there that if people have owned the wrong things, they've been punished. So around mid-November, you'll notice that both of these hit the bottom of falling channels, and we've seen quite a push higher, in both of these ratios, which in and of itself is a little bit positive in the short run, which is saying now we're finally seeing, you can see for both, it's one of the sharper rallies that we've seen in a while. So it's giving some ample opportunity for a more broader set of participation. So the thing, especially on the right, that sticks out to me is the tech ratio is now up against the top. It's obviously rallied sharply, and it's at the top of the falling channel, which potentially could be some resistance. So this will be really an interesting one to keep everyone updated on the right. This is from Sentiment Trader, something that really caught my attention in last night, especially with how important the year 2000 was. So what Sentiment Trader did is they took the AAII, which is American Association of Individual Investors, and took their stock allocation, that's what this chart is, minus the amount of stock that mom and pops, the small person in America, has, and they come up with a ratio. And the thing that sticks out is, as they tried to say last night, mom and pop are pretty well fully invested in this market. And so this shows that, you know, from let's look at the flip side. In the early 90s, this is close to the Iraq War, when Saddam became a household name. You'll see that not many people were bullish, and mom and pop had a lot of cash on hand. And hence, what did we see? Voila, the huge run up into the 90s. And then, so the ratio gets up to some of its highest levels of all time, which meant people were bullish and they didn't have much cash or much fuel, and hence was the 2000 high. Now, one of the things I want to point out first and foremost is, even though we are now at the highest level of any time, even higher than 2007, we're at the highest level as the late 90s. This level stayed up here for quite a while. So this is, again, you know, I always want to reiterate, price is what pays. We have three things in common, everybody on the call: death, taxes, and we are judged by where we buy and where we sell. So I think all of these different indicators are important, but if you try to just trade on PE ratios, imagine you missed a lot this year. You know, if you try to trade just on the margin debt's at all-time high, that's really bad, you probably missed out on a lot of upside, you know, this year. There's a lot of things that are, you know, concerning to some people out there. To me, it's about price, but this is something that gets my attention, that shows that there's a lot of bulls and not much cash. This was 2016, which was one of the lower levels. You can see here, doesn't appear to be that much different than current levels, but you'll notice the low in the markets in 2016. This is when the Dow hit the 161 level. You can see that there was a pretty high level here, build a base for a year and a half, and then when we got people a little more shook up, then it took off. But again, you don't see this very often, and again, this does not mean that some top is in play, but I do believe it's important enough that you should really know where this is, because this is the type of thing that I think has a lot to do with how we manage our risk, not the positions that we take, but do we pull up our stops and always have a feeling that we know where the exit door is in case we see price action turn negative. So really a fascinating chart from Sentiment Trader, I thought, that came out last night. This is a chart that we shared last week. So this is the Nasdaq composite, not the Nasdaq 100, which is the 100 largest tech stocks. This is a more broader spectrum. But what I did was I went back to, like we talked about in the prior chart, when mom pop weren't bullish and they had a bunch of cash accumulated in the 90s. So we took this potentially double bottom right before things went vertical, and I tied it to the tech crash bottom in 2002. And you'll notice, guess what? The financial crisis comes into play. So again, we're looking for channels, possibilities. So again, we took this triple low, did a parallel line, and I laid it on top of the tech highs of 2000. And lo and behold, the Nasdaq is testing now a similar rising parallel line to the tech high in 2000 at 2. And so I drew a rising support line. There's potential. This is, I mean, the trend's solidly up, everyone. This is a place where a SIB could take place. It could catch its breath. But it would also be concerning if we would see selling take place up here and rising support break at 3. So a big test, another big test for tech in my opinion is this ratio, which we're looking at the NDX 100, the Nasdaq divided by the S&P. So when this is rising, it's showing that tech is better owned than the S&P. In other words, that it's been stronger. So this is a 4-year rising channel's taken place. This is when the advanced decline line right in here was peaking out. This is when the Fib 161 level was being hit. You notice it was some resistance. But the bottom line is tech's been stronger. It hit the top of this trend channel. This is a weekly chart. That's so far this week. So a couple of weeks ago, it played around as almost a potential doji star reversal pattern here. It did move higher the next week, and then bang, last week we had a large decline, which meant that tech was much softer than the S&P. And so we have a potential that it's breaking rising support. But to me, the key line is the lows that took place earlier this year, that the ratio is testing that as support. So one of the things that I did is I went and shorted tech, just in case it's going to underperform the broad market. But so this is a big one to watch. This has been the leader. So this is just a leadership chart to see if the leadership role would happen to be changing. So an important support test for leadership is taking place right now. So in case, I like one of our theories is TBNM. We like to look for tops, bottoms, and no middles. So the trend definitely in tech is up. And so this is PSQ is the inverse ETF. So there's no doubt, everybody, the trend in this puppy's down. This has been a great place to avoid, and it may still be a great place to avoid. I did dip my toes into this last week, just taking a position in PSQ, and I put my stop right below these lows. In other words, if the Nasdaq would get stronger and break out, that would push PSQ down. I'm not going to I'll take a chance, a calculated chance with a small portion of my assets, but I'm not going to let this thing get away. So if with the trend being down in PSQ and up in tech, if this breaks down here, the stop would take us out. I will say this with the prior chart with the Nasdaq SPY ratio at the top of a rising channel and showing quite a bit of weakness compared to the stock market just in 2 weeks. 2 weeks doesn't make a trend, but if it would break this year's lows, and if it would break out at 2, most likely I will add to the PSQ position. So not a pure breakout of this yet. If you don't own it, that was one of the things I said, that if you want to wait for a breakout, which was solid advice or a game plan, I had an alert here that if it does break out, I will let all of you know, because I will most likely add a little bit to the position that I have. But for some of you, it may be an initial position. And again, all I'm trying to do is try to find charts that are headed from the lower left to the upper right. And again, this is not a trend play by any stretch, because the trend is down on this. Tech's been screaming higher. So this is a bet on a counter trend move. And I'm not wearing my bull or bear hat. This is just nothing more than like in the patterns, resistance, things have been pretty strong. Maybe it's time to catch its breath or a potential reversal. Another catches my attention a lot is emerging markets. They've done well since the 2016 low. You'll see that it's been one of the strongest moves right inside this green channel over the last several years. Emerging markets, this is a weekly chart, so 2.5 weeks ago, it did hit the 2011 highs as momentum was the highest since 2011, and it really even goes back quite a bit further than that. This momentum was really overbought. That doesn't mean something has to reverse, but you'll notice a rising support line is being tested while EEM is testing the bottom of this rising channel. So this is a really important price message, I believe. It's good to see, just like oftentimes we talk about small caps and micro caps in the sectors report, how that's an important message. I believe this is a very important message. Support is support until broken. Right now, EEM is testing support. So what it does at 2 could have a big influence. Obviously, if it holds its support and breaks above 1, that's a very positive message for emerging growth stories around the world and the broad markets. So a big test is taking place. I took a position today in the inverse emerging markets, just due to how high those valuations were, how strong the move was, just to see if it might catch its breath or maybe a few sellers might come in. So this is the inverse ETF EUM. This is not a leveraged ETF, but what caught my attention is there's no doubt it's been a bad place to own this, and we have not owned this, and we haven't mentioned it for years. But there is a falling support line coming into play up against falling resistance, has a chance to be a bullish ascending, or excuse me, a bullish falling wedge. If it would break out at 1, EUM could attract some buyers, and you'll notice that momentum is one of the most oversold in years. It's been down here quite a while, and it's showing a little bit of strength. So again, I took a position in EUM, trying to see if we could find another asset to go from the lower left of the chart to the upper right, and then I set my stop below this support. So I'm willing to risk around 4.5 to 5%, a part of my capital, in case we would find a bullish opportunity to break out to the upside. One of the things I want to remind from a bigger picture, the slow money, this is not about trading. This is just something that's very simple, but it works. You know, there's a lot of people around the world that have been just banging the table, being bearish for months and months and months. It confounds me why they can't just use something really simple like this. This is nothing more than taking the 200-day moving average and then taking a 4-week average of the S&P. And if the 4-week average is above the 2-week average, you're long the S&P, or it sends a positive message about the broad market. You can see when it turns the lighter, say teal colored, that means that the 4-week average of the S&P is below the 200-day moving average. So this model would suggest then that you would go to cash. So you can see in the last 2 decades, there's been few times that sell signals have happened. When a sell signal happens, it suggests to go to cash, and that's why this line would flatten. So even using something like a simple tool like this, you can see it's beat buy and hold by a pretty substantial margin. And I shouldn't say substantial, but it's beat it on the big picture to where it's up a couple 100,000 more than the buy and hold. But the bottom line is it did take less risk, you know, over time. So just a good model to keep aware of. This is the inflation growth indicator, which is taking TIP and dividing it by TLT, just to kind of look, you know, after we had the election of the president, we saw a lot of talk, we heard a lot of talk about inflationary pressures taking place, growth around the world going to take place. And you know, we did see this big rise in the ratio, but the bottom line is when we look from a 30,000 foot view, the trend is lower. And It peaked early this year and when it hit the top of the trend channel, and now it's been sideways for many months, and it's testing the lower part of this year's lows. So we're hearing a lot of talk about the Fed's going to raise rates, growth around the world, commodities heading higher. We might have inflation. When it looks at just from a purely message from this quality indicator, it's saying there's a lack thereof. And if support would break at 2, it would send a message of some form of disinflation minimally is still in play, which could ripple out or send a message about growth or lack, thereof in the economy. So a big test, in my opinion, of this important indicator is taking place. We do publish this, each week just to let everyone know how this stands in the sectors report. So big test for this theme. And I've caught it several times on the world news that people talk about in the manufacturing industry, pricing pressure from commodities. And so I just kind of wanted to update. This is a chart that we first started sharing back in 2013. But this is the Thomson Reuters equal weighted commodity index on a monthly basis over the last 30 years. And one of the things that we try to highlight to all members, for those of you that have been members since 2014, and there's many, that this looked to be a giant head and shoulders topping pattern. The peak took place in 11, lower high here, which to me looks like the right shoulder. And then we had this collapse from 2014 here, which was to me greatly influenced by what took place in the commodities, or excuse me, in the oil market, because 2015 is when oil peaked above 100, and then in 2016 oil was around $30 a barrel. I think it did get even below that. But the bottom line is if this pattern is correct, this is the neckline of a giant topping pattern. We saw a rebound in crude and then commodities. But what gets me, folks, is that this thing has struggled to do nothing more than retrace 23% of the huge multi-year collapse. And so this is when I was saying it's kind of hard to believe that there's some of these pricing pressures going on, and there is in some commodities, there's no doubt. But from an overall perspective, this puppy has struggled at this key 23% retracement level. You can see we connected the monthly high here, the lows here, and we're now kissing the underside of that. So this would be a place that if we would see commodity weakness, most likely the tip TLT ratio would head south. And so this would be a really important price point for the macro picture of what this world is doing, what takes place here. If we see a breakout above the 23% retracement level, you can see how sharp this decline was. It would probably be a positive price message for global growth, rising commodities, but we got to see a breakout before that happens. So the bottom line is this still appears to be a long-term topping pattern, and to try to prove that the long-term trend is anything but down, it needs to take out that 23% retracement level. Just a couple of quick charts on interest rates, as there's a lot of talk about rates heading higher. This is just a reminder, this is the 10-year yield over the last 25 years. The trend remains down inside the falling channel 1. Right now, yields are kissing the underside of resistance at 2. So each time that yields have been close to the top of this channel, they've been much closer to a high in yields versus a low. To constitute really that rates are going up, the first step that has to be taken, in my opinion, is to break above the channel and then above, this earlier year's highs, right in this range. And so right now the trend remains down. If rates would head higher, this would be my game plan. I don't own it this time. We actually own TLT, but this is the inverse bond fund, or bond ETF, excuse me, TBF. And it's non-leveraged. As with yields, they're heading down, so is TBF. But if TBF would happen to break out, I would be interested in owning it. Right now at this time, it looks like level lows, falling highs. Looks to be a descending triangle, which is not quite as reliable as an ascending triangle, but roughly 2/3 of the time this does break down to the downside. So a key support level is taking place in TBF. But for rates to go up, or if they really are, regardless of the reason, they need to break out of a resistance here. If it would, TBF would be on my radar to own, but don't own it at this time. Actually still own TLT. Not anything to brag about. It's been fairly choppy, but have a fairly tight stop on TLT. But just a reminder that this is typically the strong time of year for TLT. November is usually up, and so December. November was up a little bit, for TLT. The average gain for TLT in the month of December is about 1% higher. So we see that seasonally, there's typically positive wins for TLT. Haven't paid off a lot this year, but typically rates are still lower with TLT higher in December and the month of January. Still with bond, this is the bond sentiment. And you can see sometime last week I showed the sentiment on TLT. I want to just look at a bigger bond picture on overall sentiment for bonds. You can see that the bulls or bears is just about mid-range. I really prefer to see some extremes, on positioning. I just kind of wanted to let you know that there's about it's been sloshy, sideways, choppy action in the bond market, and it's pretty much reflected in sentiment as well. No extremes either way. I'm moving on to metals just quickly. I think the metals complex of gold, silver, and copper, the one pattern that really gets my attention the most is what's taking place in copper. We saw a strong rally off the 2016 lows. That's when the commodities index we shared a couple of slides earlier was testing the neckline. But you'll notice that there's some pretty stiff resistance here. Excuse me. This is a 5-year falling resistance line. And you'll notice that this is copper futures, not JJC. That several bearish reversal wicks, a cluster of them took place, right here up against dual resistance. And you'll notice that some selling pressure, these red candlesticks, the last 2 weeks is taking place. This is including, this was made this morning, even before the 3.5% drop in copper today. So there's obviously weakness taking place in copper. You can see momentum was one of the highest in years. Looks to be creating a series of lower highs and possibly breaking down. So this could send a message of some softness. Maybe some of the growth is slowing down or peaking. We'll just have to see. But this, to me, is something really worth, even without owning copper or playing it either way. This is potentially a very important price message for what copper does here, especially with momentum so darn high, and it's breaking short-term, 6 to 8 month support at 2. This is a long-term picture of gold going back a couple of decades. The main thing, two key parts of this chart to me is gold still remains above a 17-year rising support line A, the green line on the chart. So it has not been broken, and support is support. And on the flip side, gold peaked in 2011. Again, this is a monthly chart, and it remains creating a series of lower highs for the last 6 years inside of falling channel 1. So for the last many months, I imagine that the metals market has frustrated both the bulls and the bears in the metals marketplace because of this pennant pattern. And the pennant pattern would be formed by the 6-year falling resistance and 17-year rising support. You see just a lot of tightness going on here with a small drift to the downside. So a key support test on a long-term basis is at hand for gold, and a key resistance test. We've stayed away from it. This is not a market that Gold always interests me, but it doesn't interest me when it's this type of a pattern that it's compressed. But the thing we got to realize, folks, is it's going to lead to an opportunity. Excuse my French, but most likely this is pissing a lot of people off in both bulls and bears because it's just not going anywhere. And so it gets people off kilter. Oh, they're yawning, ho hum. They're not interested in it. And somewhere along the line, this is going to surprise people, and it's going to make a breakout or a breakdown. The one thing that I have to say that from a positioning perspective, not for us as members, but from a global perspective, smart money is betting it's going to break support. And they've got a pretty good sized bet from the smart money traders that it's going to break down. And so if support is taken out with not so successful money betting very much to the long side, if those traders' positions are correct and support gets taken out at a person that's willing to would want to look at shorting gold. But right now, it hasn't broken that 17-year support line, so I don't have any interest in taking that position at this time. Another message from mining stocks, sticking with the metals. This is junior miners, GDXJ, divided by senior miners, GDX. To send a quality message from a mining perspective, you want to see the ratio acting strong, and we don't see that taking place since 2011. The pink falling channel reflects lower highs and lower lows, which is a cautionary to bearish message for the miner sector. We also see, we take this is a closing chart, but the 2015, 16, and 17 lows, you can see that the ratio is actually breaking that support. So this is another negative message to the metals and mining sector. And as I shared with the smart money traders, betting to the very large percentage that metals are going to go down, this is a concerning support break for this sector. So this is a six-pack that I share oftentimes in the metals report. We have gold in the upper left, GDX in the middle on the top, GDXJ in the upper right, the GDX ratio in the lower left. In the middle and lower line is gold, the US dollar, and then steel, the steel ETF SLX. The bottom line is you see some similar looking patterns. The key is the rising blue support line looks to be breaking in each one of these. And so that's in and of itself a concerning message for the metals complex. I've been open to try to buy a bounce, but with the way the traders are positioned, it just typically doesn't lead to an opportunity there. Further weakness here would more likely the opportunity would be for those of you that are aggressive to be short the metals. So just a kind of a quick look on some valuations, just some things that I found on the web. This is a chart from the Atlas Investor. Teos puts out really good stuff. Check out his Twitter account. But this looks at the dark line on top is the S&P 500, and the bottom line is the credit spreads. Are just looking at junk bonds, the spreads inverted. So this is turning it upside down, so the chart looks a lot like the stock chart. Typically, you see it the other way around. So I really appreciated how he laid this out. The bottom line is several peaks in the stock market took place somewhere along this horizontal band when the yield spread was, around 7%, and so even though it was high, it didn't stop the market from going up. Didn't stop it from going up from the 2003 bottom to 2007. But you can see as the inverted spread was high, in other words, it was low. That's where the market peaked. We saw some other softness when it was at this level. This is where the oil started running into trouble here. So the bottom line is this is typically doesn't mean the market has to stop. This is something that we need to be prepared. Again, this is about understanding your risk management and stops. This is a price point where typically the market has historically been closer to a high than a low. Or in other words, this is a place that it doesn't mean the current trend has to stop, but this is not where new bull markets typically start or take place. Another one from Sentiment Trader that caught my attention also is that they're sharing, this is overseas buyers are just piling into US stocks. And so this looks back over the 20 years of just essentially net purchases of corporate stocks in America by foreigners. And the thing that I just want to highlight is here was roughly a little bit over a year ago, year and a half ago in 2016, before the market took off. You can see that what were foreigners doing? They were selling American shares at the lows. And so now we're seeing a lot of inflows in here. And again, this is just another good sentiment tool. To me, it's not a market timing tool, but it's a perspective on what type of stops and how much risk management should we apply to positions. With a trend up, this doesn't mean to go short stuff just because of this in and of itself. It just does say this could be long in the tooth. Doesn't mean the market can't go up a good deal higher, but this is something I just want to make each of you aware of, that foreigners are buying a lot of U.S. equities, and not that they've had a bad track record, but you see these red dots that more often than not, some key highs, especially in the 2007 range, took place when foreigners were buying to this current level. From a good friend, Doug Short, this is a market valuation using 4 different types of ratios. And the bottom line is the average of the 4 shows that the market 100% roughly above the 120-year historical valuation level in the market. This showed 1929, it was about 80% above the historical norm. This was, I mentioned earlier in the webinar, in 1965, the Dow was at 1,000. You can see it was only 42% above the standard deviation at that time of what, a 70-year look back on statistics. I happened to be lucky and to get into the business in the early 80s. You can see how much it was undervalued from the historical norm, and valuations, things were incredibly cheap. So I've been fortunate to see in my last 37 years, I got started when things were inexpensive and nobody wanted to buy stocks. This is where they wanted to buy gold. It was 800 an ounce, and that's where your future is going to be made. And treasury bills were paying 18%. Gosh, Chris, why go buy stocks? Because you could get a toaster at the bank and a 15% CD. Well, that mentality just happened to miss out on this huge bull run. But here was the 2000s when you see it was 142% above the long-term norm. So we're up there pretty rich right now. Again, this does not mean that to be bearish. This does not mean that current trends have to stop. But the statistic that you can pretty much safely say that no 5-year to 10-year bull market has ever started in America from these valuations. You know, Sir John said the 4 most dangerous words are, well, this time it'll be different. It could be different this way, folks. I don't know. It's above my pay grade. I'm going to just let price be our determinant. But I do want to let you know where these valuations are, that they're fairly stiff. And again, this doesn't have to do with being bullish or bearish. It has to do with what type of stops and risk management should you apply to your positions. Another indicator, the Q ratio from the Federal Reserve, and this is from Doug Short, and it's the balance sheet of non-financial corporate businesses divided by liabilities. You can look it up on your own, but this is another good tool. This is another 120 years of perspective. And outside of the run in the late 90s, we're as high as this ratio has ever been. You can see that it got a bunch higher in the late 90s, and if it's done it before, it could sure do it again. But just again, it's for perspective that no long-term bull market has ever, that lasted 5 to 10 years, have ever gotten started from these levels. So I'm going to give you, I can probably say most of you have sometime in your life, you played musical chairs. And what's one of the strategy of musical chairs? You see 3 people here with 2 chairs, and everybody's keeping an eye on available chairs. So that when the music stops, you know where your chair is, you know what your strategy and what you're going to do. And some people get pretty aggressive and knock somebody over trying to get that final chair. And I'm just going to be wrapping up. I've still got a few more charts, but I just kind of want to just share that some of the charts today, as I've shared, they're not about being bearish at all. It's about risk management. And what they're just suggesting, like in the game of musical chairs, is if the music stops, if the trends change, know what you're going to do. Know your own risk management. How much do I own in these positions and where are my stops? And so I'm trying to do that to the best of my ability to share with you. You've seen me continuously update and pull stops up. Sometimes it's been a great idea, and there's been times that, you know, I apologize, I was right on positions and the stop was too tight and the thing kept running to the upside. So that's a negative of having a really tight stop, is because it could keep you from some upside opportunities. But I don't feel that a stop should need to be as tight as I have some of them now if the valuation things that we looked at over the last, 100 years were much lower, or if foreigners weren't buying America, or if mom and pop had just boatloads of cash to still put in the market. So again, this is not about being bearish, it's about risk management. We'll see someday the music will stop for a while, and it'll create a buying opportunity that'll be beautiful, just like we've seen many times over 100 years. I've seen many beautiful buying opportunities that were scary, but I keep always being reminded that when I talked to Sir John's hand-picked predecessor to take over him, he said, Chris, the most excited time I ever saw Sir John, it was in the 87 crash. He was running around like a chicken with his head cut off, and he couldn't buy stuff fast enough. That's not really easy to do, but it was the right mentality at the time. So we'll still get too greedy. Bulls make money, bears make money, and pigs get slaughtered. So I'm just trying to be opportunistic with what's going on right now. And so I still think you need to keep your stops diligent and fairly tight to where we are. Enough for that. So we'll move on to the oil markets. This is crude oil over the last decade. One of the things that catches my attention is from the 2013 highs, I applied Fibonacci to the 216 lows. So roughly from 112 down here to in the lower 20s. Hard to believe there was that large of a decline in crude. We've seen a rally up, and so crude now is testing its 38% retracement level over that large decline. It's also testing this level that you can see for months. This is a weekly chart. You just see this really narrow, choppy action, and then obviously it fell even more. But we're now testing those levels and the underside of the red falling channel and the top of the blue rising channel at one. So we have I don't know that this is an 800-pound gorilla, but we are testing, to me, 3 overhead resistance levels that could become catch its breath, a SIB, or it could be a place where it actually takes a pretty good sized pause. And so this to me is an important price point for one of the most important commodities in the world. And so when we look at sentiment right now, a lot of people around the world are believing that it's going to break out. So you can see the current right now is close to 70% bulls. Right now it's the highest percentage of bulls in crude since the 2014 high. Now we did see it this high several other times, in this just choppiness that went on for years and just frustrated people because not much was happening in bullish or bearish. But this is the highest percent of bulls since the highs before we saw that 70% plus decline in crude. So also at this time, the smart money traders in crude have one of the largest bets in history, the largest bet since 2014 that crude's not going to break out and it's going to fall in price. So with that in mind, if the smart money traders are correct, or the resistance holds, or there's too many people bullish, as an example, I wanted to share a game plan with you that this is SCO, which is the 2X inverse crude oil ETF. And you can see that it's done poorly. This was the 2016 highs in this, which, because it's the inverse fund, this was the lows in crude oil. We see the trend is solidly down, but it is testing the lows of 2015 that went on for months and months, and this falling resistance line, and it could be a bullish falling wedge taking place. And again, this is a weekly chart. But I've got an alert set that if SCO would break out to the upside, in other words, if we'd see crude weakness, but if we'd see SCO break out to the upside, I'm going to be interested in being a buyer in this. And I'm not interested in buying it because it's a leveraged ETF. This, to me, is one of the more frustrating places. If any of you know out there a single X ETF with some high volume, I'm all ears. But anyway, I've got an alert set that we see an upside breakout here. I'll be looking at adding SCO as a long position. So as a reminder, I sent out last week, and I'm going to send out some charts to all of you. Didn't want to just run through too many of them in today's webinar. But these are the top stocks over the last 10 years in the month of December. And so you can see in the upper left that the average median gain of the S&P has been about 100 basis points or 1%. There have been several stocks that have done well over that time period. We still own one of them, United Rentals, at this time, which has done really well for us. But again, I just wanted to keep this list in front of you, and I'll share some charts. Obviously, if we see some positive breakouts, I'll get you a chart, and let you know. So again, I want to wish all of you a happy holiday season, a safe one, a joyous one, one of good health for you and your family. So I thank many of you for some very kind messages about my mom's passing. It was very kind to many of you. So until next year, from a webinar perspective, happy holidays.